Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Bond ETFs, your guide to smart fixed income investing. Are you looking to diversify your investment portfolio and tap into fixed income opportunities? Bond ETFs might just be the answer you've been searching for. These exchange-traded funds offer a simple way to invest in a wide range of bonds, providing both stability and the potential for steady income. Unlike individual bonds, bond ETFs allow you to spread risk while accessing the bond market with ease. Whether you're an experienced investor or just starting out, understanding how bond ETFs work can open up new avenues for smart investing. Let's explore what makes them a compelling option and how they fit into today's investing landscape. Understanding bond ETFs. Navigating the investment landscape can be overwhelming, but bond ETFs simplify the process for those seeking fixed income assets. By investing in these funds, you can tap into a diverse portfolio of bonds without the complexity and high cost typically associated with purchasing bonds individually. Let's break down the essentials of bond ETFs. What are bond ETFs? Bond ETFs, or exchange-traded funds, bundle together various bonds into a single investment product that trades on stock exchanges similar to stocks. Unlike mutual funds, bond ETFs can be bought and sold throughout the trading day at market prices. They offer a straightforward way to gain exposure to the bond market, allowing you to invest in government bonds, corporate bonds, municipal bonds, and more, depending on the ETF's focus. This makes them an approachable option for investors of all experience levels seeking to add bonds to their portfolios without the hassle of managing numerous individual bond investments. How bond ETFs are structured. Understanding the structure of bond ETFs can help you grasp how they function. Essentially, these funds are composed of a collection of bonds selected based on the ETF's investment objective. The types of bonds in a bond ETF can vary widely, from government bonds, which are generally safer, to corporate bonds, which might offer higher yields but come with more risk. Some bond ETFs specialize in specific durations, such as short-term, intermediate, or long-term bonds, allowing you to align your investment strategy with your financial goals. The fund manager oversees this mix, ensuring it aligns with the ETF's stated objectives, while the ETF itself offers a layer of diversity not typically achievable when buying individual bonds. Benefits of investing in bond ETFs. Investing in bond ETFs comes with a variety of benefits that can enhance your portfolio's performance and resilience. Here are some compelling reasons to consider them. Liquidity. Bond ETFs can be traded like stocks, providing you with the flexibility to enter or exit positions with ease. This liquidity is a notable advantage over traditional bonds, which often have limited secondary market trading. Diversification. By holding a mix of bonds in one fund, bond ETFs offer an automatic form of diversification. This spread helps mitigate the risk associated with any single bond defaulting. Cost-effectiveness. Bond ETFs can be more affordable than purchasing a suite of individual bonds. They often have lower expense ratios than mutual funds too, making them a cost-efficient way to access the bond market. By understanding these core aspects, you're better equipped to make informed decisions about how bond ETFs could fit within your investment strategy. While they offer a multitude of advantages, it's essential to weigh these against your financial goals and risk tolerance before diving in. Types of bond ETFs. When it comes to building a well-rounded investment portfolio, bond ETFs are a versatile tool. They allow you to access a range of bond markets in one neat package. Different types of bond ETFs cater to various financial goals, risk tolerances, and investment strategies. Let's take a closer look at the most common types available. Government bond ETFs. Government bond ETFs invest primarily in bonds issued by a national government. These bonds are generally considered low risk, as they rely on the government's ability to repay the debt. Common examples include U.S. Treasury ETFs, which are backed by the full faith and credit of the United States government, offering stability and security. Investors might choose government bond ETFs to safeguard their capital during uncertain economic times. In return for this safety, the yields might be lower compared to other bond types. Corporate bond ETFs. Corporate bond ETFs focus on bonds issued by companies. They typically offer higher yields than government bonds, reflecting the added risk of lending to corporations. Investing in corporate bond ETFs is a way to benefit from the growth of businesses without buying individual corporate bonds. They offer advantages like higher potential returns and exposure to various sectors of the economy. For investors seeking to balance risk and reward, corporate bond ETFs might be an ideal choice. Municipal bond ETFs. Municipal bond ETFs invest in bonds issued by states, municipalities, or counties to fund public projects. One of the standout features of these ETFs is the tax benefit. Interest earned is often exempt from federal taxes and possibly state and local taxes if you reside in the issuing state. These tax exemptions make municipal bond ETFs particularly attractive to investors in higher tax brackets looking to maximize their after-tax income. However, it's crucial to consider the credit risk of the issuing authority and the general economic health of the region. High-yield bond ETFs. High-yield bond ETFs comprise bonds with lower credit ratings, sometimes known as junk bonds, that offer higher potential returns. While they are attractive for their higher yields, they carry increased risk, including the possibility of default. These ETFs can introduce significant volatility into a portfolio, suggesting they are suitable for investors with a strong appetite for risk and the potential for larger gains. It's like walking a financial tightrope, high stakes, but for some, that's where the excitement lies. International bond ETFs. International bond ETFs invest in bonds from countries outside the investor's home nation. They offer exposure to global debt markets and can help diversify a domestic-heavy portfolio. However, these ETFs come with currency risks. Fluctuations in exchange rates can impact total returns. Investors might use international bond ETFs to exploit opportunities in rapidly growing economies or to hedge against domestic economic downturns. Navigating these ETFs requires a good understanding of geopolitical climates and currency trends. Investment strategies with bond ETFs. Bond ETFs offer a strategic way to build a solid investment portfolio. Their flexibility and diversity make them suitable for various strategies aimed at enhancing returns and managing risk. Here we discuss two effective strategies: laddering and duration management. Laddering strategy. Explain the laddering strategy using bond ETFs. Laddering is a well-known strategy used by investors to manage and mitigate risks associated with bond investments. Here's how it works with bond ETFs. Imagine setting up a series of bond maturities like the rungs of a ladder. Instead of investing all your money in a single bond ETF, you spread it across multiple ETFs with different maturities. This staggered maturity profile ensures that when one bond in the ladder matures, the proceeds can be reinvested into new bonds at current interest rates. Why laddering with bond ETFs? Stability. By spreading your investments across multiple maturities, you reduce the impact of interest rate fluctuations on your portfolio. If interest rates rise, you can reinvest maturing proceeds at higher rates. Liquidity. This strategy ensures that part of your investment matures regularly, providing liquidity without having to sell off longer-term holdings. Income consistency. Regular maturities also mean a steady stream of income, important for those relying on their investments for cash flow. Think of laddering as having your safety net while reaching for higher yields. This balance of security and opportunity is what makes laddering a staple strategy for many investors. Duration management. Discuss how duration affects bond ETF performance. Duration is a key factor in understanding how bond ETFs perform, especially when interest rates change. Duration measures how sensitive a bond or bond ETF is to interest rate movements. It's a bit like the steering wheel of your portfolio, helping you navigate through the ups and downs of the market. But how does duration work in practice? Interest rate sensitivity. A bond ETF with a longer duration will see larger price changes when interest rates move. If rates go up, prices of long-duration ETFs go down more steeply than those of short-duration ones. Portfolio goals. Aligning the duration of your bond ETFs with your investment horizon and risk tolerance is essential. A longer duration is suitable for investors confident in a stable or decreasing interest environment, while a shorter duration fits those wary of rising rates. Managing duration is a bit like adjusting the sails of a boat. When the wind shifts, you want to be prepared, not caught off guard. Controlling the duration of your bond ETFs ensures your portfolio is balanced and ready for whatever market conditions might come. Using strategies like laddering and duration management with bond ETFs can help you create a robust, adaptable portfolio that can navigate today's ever-changing financial seas. Risks involved with bond ETFs. Investing in bond ETFs comes with its own set of risks that you should understand before diving in. While they offer diversification and the convenience of trading like stocks, certain pitfalls can affect your investment's performance. Let's break down some key risks you need to be aware of. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.